I am Rakesh Murria. I am the COO here at Ascension, and today we are going through our Pulling All the Levers presentation. Again, this webinar, which should hopefully give you some reasonable ideas about some of the changes that have come with the budgets and some interesting ways in which you might be able to use EIS in order to help with that. On the call, I've also got Bill, our head of distribution, and Ben as well, our most recent addition to the distribution team. So say hi to them. I'm sure there's a joke to go with their names. Ascension is an early stage technology investor. We have a tax efficiency score of 86. We were CBC of the year in 2022. We've been very active in the market and sort of a lot of recognition for that. I'm only going to talk briefly about us before I go into the meat of this. So if you just give me a second. This presentation is for financial intermediaries only, which is fairly obvious. I know you've all been invited, but this is the first of two disclaimers I'm going to give you. That's how disclaimer I'm going to be today, being the head of compliance as well. So just a quick bit about Ascension. We are an early stage technology investor. This is our 10th year. We've been investing in the UK tech ecosystem since 2015. We've got 100 million AUM, over 150 portfolio businesses, and 14 profitable exits that we've had in that time as well. This is our sort of funds that we run. So we have our SEIS, EIS, and KI funds, which basically run on the same thesis, but at different stages. So obviously SEIS, the earliest check that you'll probably write into a company, EIS and KI late stage investments into those. We've got our Firm by Design EIS, which co-invests with our institutional fund, and our carryback EIS for those people looking for rapid deployment this tax year. I will talk about those a bit more at the end. So if you want to know a bit more about them, I will go through that towards the end. But the first thing I'm going to do before we get into the meat of the sort of ways to use these kinds of products of SEIS and EIS is a quick recap of the benefits of SEIS and EIS as well. I'm going to start with SEIS. As I said, we've been running an SEIS fund for 10 years now. We run it annually, and it comes with incredibly attractive tax breaks, which for the right kind of investor, i.e. somebody that has both income and CGT bills, will mean that you are basically only putting 13.5% of your investment at risk. And so how do we get to that number? There's a 50% income tax relief. You can do up to £200,000 of SEIS in any particular year and get 50% of your investment back in tax relief. So £100,000 for that £200,000 investment. There's also CGT reinvestment relief. So capital gains bills can be reduced by up to 14%. By up to 14%. Which can be super useful if you have a capital gain bill to just write it off as well. And then on investments that fail, there's also loss relief available. So if you take those things together, the 50% income tax relief, the 14% CGT reinvestment relief, and the 22.5% loss relief, you're putting 13.5% of capital at risk. So despite it obviously being the most early stage of investing that you're doing, and therefore you would say the higher risk end, you get in terms of the capital at risk with the tax breaks that the government provides, you can see how interesting it looks. And then of course we're doing all this for growth. So we've got tax-free returns on those investments held for 3 years. And then the other part of this that's super interesting, I'm going to talk about both of these later, but inheritance tax relief, 100% inheritance tax relief on the first £1 million of these kinds of products. And business investment relief as well, which can supercharge this whole thing for investors. And then the SEIS reliefs, the EIS reliefs are again super attractive. You can invest a significant amount more in EIS than you can in SEIS. You can do up to 2 million rather than 200,000, but it still comes with very attractive tax breaks. Here we're talking about 30% income tax relief, 31.5% loss relief for a top rate taxpayer as well. So those two together put 38.5% of capital at risk. Rather than CGT relief, there's CGT deferral, which allows you to postpone paying capital gains tax on the amount that you reinvested into EIS, or equivalent to the amount you've invested in EIS, which is super useful because you can take that capital gains bill and try to grow your money before you pay the bill. But it's also incredibly useful when it comes to estate planning benefits, which I have no better way of saying this, which is that the gain dies with the investor when it comes to these products. So actually moving, having some of these products in EIS and then handing them down can actually, as part of estate planning can bring a lot of benefit as well. And then again, those tax-free returns, the inheritance tax relief that I talked about, and the business investment relief. The eagle-eyed of you will notice that CGT at a top rate is actually 24% rather than 28%. And not just that I can't be bothered to change the slide, but there are a category of investor, which I'll talk about today, that are paid in something called carried interest. And that carried interest is charged at 28% at the moment, rising to 32% in April before it moves into the income tax regime in a year. And I will actually touch on those kinds of investor more later. And so here, what I'd just like to give you is basically, if you think about the structure of what I'm trying to describe to you here, the first two slides here are, what am I putting at risk? If everything fails and liquidates for zero, what is my capital at risk? And then the next stage of this build that I'm trying to show you is, what do I have to believe in order to get my money back in this kind of investment portfolio? And so with the benefits available, a single 5.5 times return on one business out of a portfolio of 10. The reason I choose 10 is because that's the portfolio size that we build our investors, including all of Ascension's fees and charges and everything else that you would get from us, will actually deliver you a profitable return on your investment. And I'll just walk through that now. So I've taken £100,000 investment, so I can do the maths easily, which is 10K per business. And in this case, we have one fee that we'll charge you at the start of all this, which is our initial 5% investment fee. Some funds charge a lower initial and then have holdback for management fees, etc. And maybe 90p is invested or 89p is invested in the pound. We do this sort of flat 5%, and we charge it separately if you want. So therefore, you don't have to try to work out, if you are trying to hit a tax number, what kind of investment size I need to do. So if you wanted to get 30K of tax relief, I do a £100,000 investment. I pay the barcode fee separately. I don't have to gross it up to work out what that number is. And in this example here, we have that one £10,000 investment, got £3,000 of initial tax relief, 5.5 times return, so 55K including the amount you invested, and £58,000 there. And the other 9 investments, £90,000, fail. So you have the £27,000 of initial relief and £28,350 of tax relief too. And then I've done this over a 5-year time frame. So the only fees that Ascension would charge you at this point is our deferred management fee. So we don't charge management fee up front or ongoing. We charge it on realization only. If you don't have any realizations, you don't get any charges. In this case, I've assumed this happens over a 5-year time horizon. And so I've charged our 1% per year management fee plus EAT, which is £6,000. And you can see here in the bottom that £100,000 after all fees still came out at more than £100,000 investment. So, starting with, what do I need to believe? What do I put at risk? Followed by, what do I need to believe in terms of making a profitable return? And then let's play that into, what does Ascension's real world track record look like when it comes to this? So this is our track record from October 24, with the most recent update we did. Down the middle, you can see the 1x value of investment. The green bar here is the gross realized value, and the blue bar on top of it is the unrealized value still sat on the table. And you can see here that across the board, Ascension started returning significant amounts of funds back to its investors. And in actual fact, even our Fair by Design institutional fund, which is a tech for good fund, has almost fully returned its first 2 years back to investors too. And actually, if you add the tax release in on top, you can see that investors are back in the black in 3 funds and very close to their full amount returned already from other funds too. So just to give you that picture, I keep clicking through and running through it, but worst case, in inverted commas, what do I have to believe? What the real world look like so far? And of course, past performance is not a reliable indicator, but you'd also never invest in someone that had no track record, I guess. So that's one of these sort of things that we talk about. So it is 9:41, and now I'm going to get into the meat of this presentation, which is called Pulling the Levers. You can see I've got this fun and interesting AI generated slide of a finance professional somewhere in London pulling a bunch of levers. You can see ChatGPT is definitely not wasted on me when it comes to, getting the best value out of it. So the first thing I'm going to do here before I move on, I told you I'm going to double disclaimer you today. And so here is the next disclaimer. And that disclaimer is that this is a set of illustrative ideas, right? These are ideas for you to consider for your clients. Only some or perhaps none of these may be suitable for your client, and each individual circumstances are completely different. And therefore, these are a set of ideas for balanced portfolio and planning. And strategy consultant timing here, but slideware here, but you can say, what are we balancing off? We're balancing off the benefits of income tax relief, inheritance tax relief, and other benefits, capital gain benefits, etc., with, the risk appetite that your investor has for early stage investments and the illiquid nature of EIS. And so in summary, this slide says the job that you already do, which is to take all these things into account, is the kind of thing that you should take into account. Sorry for teaching you to suck eggs, covering my yellow behinds. So the first thing that we're going to talk about here, which is there's going to be a lot that I go into in this. And just so you know, all these slides are going to be available. A recording of this presentation will also be made available to you as well. But the first major change that I've spoken to lots of advisors about, definitely something that's coming as food for thought for people is coming, is the changes to pension taxation when it comes to inheritance tax. So from April 27, unused pension taxes, pension funds and death benefits will basically be subject to inheritance tax. So a 40% inheritance tax on the money. And then on top of that, let's say you're a top rating payer of tax when you got this, when you inherited this, your beneficiary, you'll still pay income tax on the money that you're also inheriting too. So IHT and then income tax. And that is an effective tax rate of 67% on something that many advisors I've spoken to have been using, effectively setting aside pension pots for their children or for people's children as a part of a standard part of planning. And all of a sudden there could be an up to 67% tax on it. This is a significant challenge that we know, and we think that strategic planning and using things like the EIS scheme can significantly mitigate this. So I'm going to walk into it here. So what's the idea? The idea is that I had this pension pot that was set aside for my children, and now I'm going to draw down from that pension pot, take a tax-free lump sum from that, and also then do drawdowns. I do drawdowns over a number of years, and the reason for that is I actually did a podcast recently with Hartman & Co. on this exact subject. Hit up my LinkedIn if you really want to see it or listen to it, but actually, hopefully this will give you what you need. But the idea of investing over time is also important. So as financial professionals, I'm sure that when you do this kind of investing, you do it across a number of funds to get diversification across the funds that you're investing in any particular year, but also doing, as Brian Moretta described it, temporal diversification. So over time as well, investing, not just taking a whole bunch, just taking it in 1 year, allows you to also not be subject to the whim of one economic cycle, right? Did I get a brilliant year of 2019, 2020, or did I end up with 22, which was the 21, 22, which was, high valuations? Is Russia going to invade Ukraine? Are we going to have tariffs for 1 day on China or whatever? Yeah, you're just going across a time frame. And so this example takes that lump sum, then does a drawdown and takes that drawdown and invests a significant amount of that drawdown into EIS over 5 years. And what I'm going to give you is the range of examples on this. Back to my strategy days. If you've got something complicated to describe, I try to describe it in a waterfall. So the idea here is an investor can take their tax-free lump sum, this 125K here, and then 5 years of 75K per year to draw down the other 375 of this 500K. Now, this example, instead of giving you two ends of it, this is an example of somebody that doesn't pay income tax at the moment, right? So they have their allowance, they have their, they'll not pay top rate on the income, etc., that they get from the pension. And so this gives you the low end at risk, and I'll give you the high end at risk in the next slide. And so on that 375,000 drawdown, you would pay £87,000 in tax, and then you're going to invest 50K a year. So not all of it, you're going to keep some of that money. You're going to take 50K a year and put that into EIS, which is this slide here, right? And then from that EIS, you will get £75,000, 30% in income tax relief. So, and of course, that nets out mostly the income tax that you actually paid on your pension drawdown, is my point. And now the thing to remember is here, there was a £500,000 pension pot that you were setting aside for your kids. That would have been subject to IHT, but you're no longer paying that, right? So between you and your beneficiaries, that £200,000 no longer exists. So on this green backup, you've got this 75K of EIS relief, and then another £200,000 of IHT mitigation. So in actual fact, before you think about a penny being returned from the funds or any kind of loss relief you might get from the funds, you have put £6,000, 12.4% of that 500K at risk, right? And the maximum loss relief that somebody could get would be 79K, by the way. So you could actually almost make it back again. Not trying to sound too negative about it, or just trying to give you a picture. So that you can see here that there's 62K at risk. And then let's say we start returning you some money. 1x return suddenly turns out 500K into 65K basically. 2x return makes it 940K. And a 3x return makes it about 1.2 million. And those three numbers I put there is to give you an example of each. And Ascension's target is a 3x return, which is why I've given you those three ideas. So you can see tax treatment puts you in a great position before you get started. And then returns are like more than the cherry on the cake. It's our job, but you can see the value that's brought in. And then here is the top rate taxpayer version of that exact same piece, right? And here you're putting 143K at risk before any potential loss relief in terms of this gap here between the 500,000. And then you can see a 1x return is 600,000, 2x return is 850, and a 3x return is 1.1 million. As I said, we're going to make these slides available to you, but hopefully you can see this is a reasonable way of trying to illustrate how you can mitigate these IHT bills, invest for growth, get some returns, and actually be in a better position than you would have been before, and taking out this impact of IHT as well. So that was probably like, the one that I've spoken to the most people about, where there's a lot of interest coming. This is probably the next one in that criteria, which is about transferring from AIM to EIS. So from April 26th, there's going to be a significant change in AIM treatment, which is before those shares were completely tax-free. And now in portfolios will be a 50% relief rather than 100% relief. And therefore you're going to have an IHT rate of 20%. And so what we're doing here is giving an example of saying, what if I transferred a portion of that AIM holding into EIS? And there's some really interesting bits that come with it. And what I've done here is taken a very simple linear scale, right? So what happens about £1 million AIM holding, and I transferred none of it, or I transferred all of it, and I go in 20% increments to show you what's effectively the net tax swing. But there's a couple of things about here. So first of all, as the legislation is currently written, we're waiting for the formal legislation to come, but as it's currently written, these AIM products, which you may have held for 2 years already, would actually qualify for business property placement relief immediately. So there was no new IHT relief waiting period on the EIS investment. You're going to significantly reduce your IHT liability by doing this. And there's also the fact that you're going to get income tax relief if you have income tax. There's going to be income tax relief on the money that you invest in the EIS. And of course, the same points come from earlier, right? What illiquidity am I willing to accept from my investor? The higher risk, and the general complexity of these kinds of investment. The other really interesting thing, by the way, is if you made a gain on these AIM holdings and had to pay capital gains, actually you can do CGT deferral with your EIS investment, or CGT write-off with an SEIS investment for this same investment. Really quite interesting. I've gone with EIS, which is the lower end. You could imagine if I were to swap this out into a couple of £100,000 of SEIS relief on top as well, you can see what you might get. But in effect here, a 40% transfer, so 40% of your AIM holding to go into EIS would have a tax swing that is equivalent to the IHT you would have paid. So your IHT bill goes down to 120, you're getting 120 at EIS relief. And so your net tax swing is quite significant in terms of what you're having there. You could go all the way, you could go some of the way, but it's an interesting way of looking at it, we think. And then, of course, there's the CGT deferral that we talked about as well. Appreciate that I'm rattling on, but just trying to make sure that we cover all of this. And as I said, all these slides are being made available to you. The last couple of areas I'm going to talk to here are a bit more niche, but also if you spot this kind of investor, something that you should certainly probably take an interest in. So the first thing I'm going to talk to you about here is the capital gains tax on carried interests. So there's a group of individuals, about 7,000 of them, that basically make their earnings in what's called a carried interest. And that's because they're either private equity professionals or fund managers of some kind, and they get paid in carried interest. And carried interest is subject to the CGT. That's the bill that you pay. By the way, all of these people are almost certainly top rate taxpayers too, right? So they have significant amounts of other income outside. But that CGT rate is 28% going to 32 before it moves into the income tax bracket next year. In terms of size, I said there's only a few people. Why would you care? They paid about £1.4 billion in tax, roughly. Interesting because they have a lot of income and there's a lot that they could benefit from in terms of SEIS and EIS write-offs. What's the idea? Just taking some of that income that you are earning now and making sure that you basically, as part of this investment, potentially max out your release that you can get against that carried interest that you're doing, which is £200,000 of SEIS would yield £100,000 in income tax relief plus 32,000 in CGT on carried interest coming in April. And for EIS, every £100,000 yields 32k of capital gains deferral plus 30k of EIS deferral as well. Sorry, EIS relief. So there's significant amounts of relief, significant amounts of deferral available to investors. And we think it's just, if you have this kind of investor, if you know who they are, if you meet someone that works in this kind of space, definitely worth making sure that they're using their allowances as they would need. And as I said, I think the average income of these people was somewhere in the sort of 5 to 15 million a year kind of bracket, right? You're not talking about people who are not going to be able to make this kind of investment. And then finally, in terms of these ideas, again, just looking for the right kind of investor. You'll have seen this in news about Rachel reconsidering some of this as well when it comes to non-dom. But if you have, or the removal of the non-dom scheme in a year or two, leveraging business investment relief to supercharge investments. So business investment relief allows UK resident, non-domiciled individuals of which I'll give you examples, horrendous examples. I'm sorry, football managers, footballers, all rig workers. Some examples there, they might earn significant amounts of money, but also have income and money from overseas that they would like to bring to the UK. If you bring that into the UK, you will pay income tax on that, or you will pay tax on that money. If you invest it into qualifying companies, which is the same as the EIS qualification within 45 days of bringing it in, you will not pay any income on it and not pay any tax on it and still get EIS relief on your UK income. So you basically getting double bubble, as the phrase goes, on your investment. And so again, I have to give you a waterfall to explain it if I feel it's complicated enough. So what I've got here is a £1 million investment, or £1 million of offshore money brought onshore on the left-hand side, where somebody paid 45%, 450k in tax on it, and invested the remainder in EIS, right? So they did 550k into EIS. They got £165,000 of tax relief on that. And we did our job. I told you our target before is a 3 times return. We did our job and we returned 3 times your money, 1.65 million return and a £1.8 million total return, including EIS relief. That's your cash position. Absolutely amazing. Any investor would be happy with that, I'm fairly sure. Now imagine that you did not have to pay the UK income tax on that portion and did exactly the same investments of the portfolio on the left, but just put more money in because you had more money to invest. In this example, that £1 million is subject to no tax. The way we do this, by the way, is we just have an offshore banking facility. You do your subscription to the fund. That money goes into our offshore bank account. It sits in our offshore bank account and we bring it onshore just in time for the investment. So it never violates the 45-day rule that there is in terms of when you can invest it. So you've got £1 million of EIS investment instead of 550. That's £300,000 of EIS relief. And then we do our job again, do exactly the same portfolio, got exactly the same return, 3 times return. That 1.8 million before is now 3.3 million, almost double, because the savings made by using BIR. So if you meet these kinds of individuals, if you come across them, it's always worth checking on their status, because there is a significant amount of value that they can get by using this, and they will still get EIS relief and SEIS relief as well on their UK investments. So that was the examples that I was going to run through. Hopefully you've seen at Ascension, we run our webinars. We like to run them on time. So you can see we've got 4 minutes left. And in that, I'm just going to talk to you about where we're at in terms of the funds. So our 2025-26 SEIS fund is open for investment. It's a pure SEIS fund for the first 2 million. Anyone above that will be on EIS terms. There is £900,000 of pure SEIS left for those looking to subscribe. That we do expect that to be fully gone by the time we get to April. So if you're looking or have interest, drop us a line and we can have a chat with you about it now, and maybe set some aside for you if you've got a client that you specifically talk to about it. We've got our Ascension EIS and KI funds. So right now, we are past the 25th, but we've got, I think, a couple of days, but basically you'll get a portfolio of 3 companies now if you invest alongside our existing investments for the final investments of the year, right? If you're rapid deployment in this tax year. Alternatively, you can invest in our 2025 knowledge intensive fund, which is exactly the same thesis as the EIS, but knowledge intensive businesses only. That will invest in a portfolio of 11 over about 12 months. And it's dated on the 3rd of April. And so it's anchored in the 24-25 tax year, which will allow you to carry back to the previous tax year for tax relief purposes or income tax benefits. There's our Fair by Design EIS, which will have an April 3rd close for co-investing with our institutional fund. And in companies that meet the thesis of that as well. And as I said, you saw the track record of our institutional fund earlier on that front. And then finally, if you're looking for rapid deployment right now, we have our Ascension Carryback EIS, Ron Seal naming, does what it says on the tin. The idea being is that it will co-invest with the deals that we have going on, as well as do follow-on investments, so follow-on rounds for companies that our fund might not be able to do because some of the rules that we have. Interesting preemption. Some are following some of our winners. And that will fully invest in this tax year so that you can get your certificates quicker than you would with a KI fund. And if you have a particular CGT deadline, if you're trying to get up against the line for that, also very valuable for doing that too. So that's our kind of spectrum of funds. The 2 rapid deployment icons on the top give you an idea of what you can use to carry back. And that was me. So thanks ever so much. We'll have Bill and Ben and myself will follow up with you post this call. It was really great to have you with us and look forward to speaking to you again soon.